Have you ever wondered how options trading works? Maybe you've heard about it and want to get in on the action. Well, you're in the right place, and we're about to demystify this concept for you. Options trading revolves around contracts, specialized agreements that grant the buyer the right, but importantly not the obligation, to buy or sell a specific asset. This could be a stock, a bond, a commodity, or even a currency. However, this is not a free-for-all. The contract specifies a predetermined price and a specific time period within which this transaction can occur. Think of it as a reservation at a fancy restaurant. You have the right to dine there, but you're not obligated to show up. And just like your reservation has a specific date and a set menu price, an options contract has an expiration date and a strike price. Now that we've laid the groundwork, we can dive into the three key characteristics of options trading: expiration date, strike price, and a little something called a multiplier. So what makes options trading unique? It's all about the expiration date, strike price, and multiplier. Let's start with the expiration date. It's the date at which the option contract becomes void. The holder of the option has until this date to make a decision about exercising their right to buy or sell the underlying asset. If the expiration date passes without any action, the option simply expires worthless. The expiration date is important because it affects the value of the option. Generally, the longer the time until expiration, the higher the price of the option. Next, let's talk about the strike price. This is the predetermined price at which the holder of an option can buy or sell the underlying asset if they choose to exercise the option. The strike price is central to calculating the payoff of the option. If the market price of the underlying asset is above the strike price for a call option or below the strike price for a put option, the option holder can make a profit. Lastly, we have the multiplier. This number determines the total value of the option contract. Typically, one options contract represents 100 shares of the underlying asset. So, if you buy one call option, you have the right to purchase 100 shares of the underlying asset at the strike price. The multiplier is crucial as it magnifies the potential profit or loss from the movement of the underlying asset's price. So you see, these three characteristics, the expiration date, strike price, and multiplier, shape the value of an options contract and the potential profit or loss you can experience. They make options trading a flexible and potentially profitable venture, allowing you to control larger amounts of an asset without owning it outright. Understanding these characteristics is crucial, but to really grasp options trading, we need to delve into specific types of options: call and put options. Call options, put options, they might sound like fancy financial jargon, but they're actually pretty straightforward. Let's break them down together, shall we? First, let's tackle call options. When you buy a call option, you're securing the right, but not the obligation, to buy an asset at a predetermined price, known as the strike price, before a specific date, the expiration date. The catch here is that you're betting on the price of the asset going up. If the price does increase beyond your strike price before the expiration date, you can exercise your option, buy the asset at the lower strike price, and sell it at the higher market price. And voila, you've just made a profit. But if the asset's price doesn't climb high enough, you may choose not to exercise your option, and your potential loss is limited to the premium you paid for the option. Now let's flip the coin and talk about put options. A put option is essentially the opposite of a call option. Here, you're securing the right to sell an asset at a predetermined price before a specific date. With a put option, you're anticipating a decrease in the asset's price. If the price dips below your strike price before the expiration date, you can exercise your option, buy the asset at the lower market price and sell it at the higher strike price, thus making a profit. But if the asset's price stays above your strike price, you may choose not to exercise your option. Your potential loss in this case is just the premium you paid for the option. So in essence, call options can be profitable if the underlying asset's price increases, while put options can be profitable if the asset's price decreases. It's all about predicting market movements and managing your risks. With these options in your trading arsenal, you're well on your way. But what about option pricing? How do we determine the value of an option? Option pricing might seem complex, but once you understand the concepts of intrinsic and extrinsic values, it becomes a whole lot clearer. Let's take a moment to delve deeper into these terms. Intrinsic value refers to the difference between the market price of the underlying asset and the strike price of the option. If this difference is positive, the option is said to be in the money. If it's negative or zero, the option is out of the money or at the money, respectively. This value signifies the profit that an option holder would make if they were to exercise the option immediately. On the other hand, extrinsic value, also known as time value, is the part of an option's price that exceeds its intrinsic value. It's influenced by factors such as the time remaining until the option's expiry, the volatility of the underlying asset, and interest rates. The longer the time until expiration, the higher the extrinsic value, as it gives the underlying asset more time to move in a favorable direction. Now let's talk about the impact of the expiration date on an option's value. As the expiration date approaches, the option's extrinsic value decreases, a phenomenon known as time decay. This is because as time runs out, the probability of the option becoming profitable decreases. In a nutshell, the price of an option is determined by its intrinsic and extrinsic values, both of which are influenced by a variety of market factors. As with any form of trading, options trading comes with its own set of risks and benefits. Let's explore them. Options trading can be a lucrative venture, but it's essential to be aware of the risks and benefits. The allure of options lies in their versatility, offering opportunities for strategic investment and hedging, even when the underlying asset underperforms. However, they come with risks, including potential loss of the entire investment. Yet, the beauty of options is that they allow you to control these risks. Armed with this knowledge, you're now ready to embark on your options trading journey. Remember, every successful trader started as a beginner.